United Parcel Services Inc., or UPS. Ticker symbol UPS. Before we get started, I'd like to humbly ask for you guys to subscribe. I just hit 100 subscribers, which was a really big accomplishment for the channel, and I'm hoping I can get hundreds and hundreds more of you guys with my stock analysis videos. So let's get into it. UPS currently trades for $132.55. The stock's down 16.42% over the past year. The market cap of the stock is $113.11 billion. The price to earnings ratio is 20.04, and the annual dividend yield is 4.92%. Now, we also have some of the analyst opinions here. As we can see, there are, I believe, 30 total. This is in January right here. You have maybe like 3 with a strong buy, 15 with a buy, 9 with a hold, 1 with an underperform, and 2 or 3 with a sell. It doesn't have the total number. But analysts are kind of split on the stock, more generally bullish though. And we also have the analyst price targets here to the right. So this is where analysts think that the stock's going to be worth 1 year into the future. And currently they range from $100 to $179 per share, with the average being about $148.71. And the stock currently trades for $132.55. So it's under that average, but it's above that low. So, some analysts think that the stock is going to be worth $100 in 1 year because they're not going to perform in the way that they should, or they're going to perform below the expectations that are priced in at this level. Next, I have my working average cost of capital. Here I have the interest expense, total debt, income tax expenses, income before tax, and then we end up getting a cost of debt after tax of 2.425%. And then that's going to be the rate at which we multiply by the total debt. As you can see, they don't have a lot of debt. Cost of equity, which is essentially literally going to be the weighted average cost of capital because the weighting's so skewed, is going to be 4.79% for the risk-free rate, 0.98 because that's the beta of the stock, 7% average market return, and that's our cost of equity, 6.95%. So as you can see here, their average growth rate of free cash flow is 10.2%. This is with this anomaly year from 2020 to 2021. So the cash flow on average over the last 3 years has actually decreased about 14%. So by my model standards and with a perpetual growth rate of 2.5%, adding all their cash and cash equivalents, subtracting their total debt, dividing it by the shares outstanding, I have a fair cost per share of 132.24, but that is of course assuming a 7% annual growth of the free cash flow over the next 9 years. So more realistically, I think that this stock is probably overvalued currently. I think it's lofty for what it is. I think that they're losing market share to Amazon. But, I also think it could be realistic for a 7% growth rate of that free cash flow because maybe they're going to be able to do increased volume because this is going to, just get bigger. Maybe they're going to be able to do it for cheaper. Maybe certain merchants who are seasonal are going to be sending stuff more. Anything they can do to drive down costs because I feel like there isn't a lot of growth left there. I think if they can optimize, this would be a buy. But as is, personally, in my unprofessional, just entertainment, non-financial advisor opinion, I don't think you should buy UPS. I don't think it's worth the risk. I think Amazon is way better, but I'm also super biased because I own Amazon and I've made a lot of videos on Amazon on why I think it is probably the best stock to be buying right now. And, I just don't think UPS has a lot of ways to grow. It feels very consistent. It feels like a stock that's going to work like a bond where they're essentially going to increase by 1 or 2% annually, but they're not really going to significantly grow cash flows anymore. They're just too big already. I don't see UPS being a buy here. I think because even 6% free cash flow growth, which would be really good for UPS on average, is, still underperforming the price of the stock. I mean, it's literally like at 7.1, around 7.1%. Is what they're expecting, and I could be proven wrong, but I just don't think that this stock is a buy. I don't think it's monopolistic in any way. I think you're competing with Amazon in your core business, which is never a good idea. Um, I also think they're a very mature company. So I don't think there's a lot of ways for them to get to new areas or do different things. They've kind of optimized everything really well. And they're not monopolistic in the product that they offer. So it's a very competitive landscape. And I don't like companies that are competitive and mature because there's not any growth left. And they're pretty much significantly delivering you the same thing with some surprises to the upside and the downside. I like a consistent upside growth type of stock personally. So fundamentally, I just don't like this stock. I don't think it's cheap. I think it's very close to fair value or, overvalued. I think more likely overvalued, but I would say it's probably pretty close to the fair value of the stock. And I don't think that they have significant advantages, and I just don't understand how they can grow. So I'm just not going to touch this. And that's my review of UPS stock. Let me know what you guys think in the comments section if you like the review. If you don't, yeah, I don't think this is a buy.